April 29, 2024. 10:03 a.m. Tokyo time. Trading desks across Asia exploded into chaos. On the 34th floor of Capital.com's Melbourne office, 6 currency traders suddenly started shouting the same number, 160, 160, 160. It was like a game of bingo, but this wasn't a game. The Japanese yen had just crashed through a psychological barrier that hadn't been breached in 34 years. 160 yen to the dollar. The exact level where, back in 1990, Japan's economic miracle began its long, painful decline into what would become known as the lost decades, for Colorado, the strategist watching from that Melbourne tower. The scene was surreal. Trading volumes exploded to 5 times normal levels. Everyone was trying to buy the dip, betting on the next move. From Melbourne to Sydney to Tokyo, traders who'd been planning to enjoy a long holiday weekend were suddenly glued to their screens. And then, something extraordinary happened. In the span of just 30 minutes, the yen didn't just stop falling. It rocketed back. From 160.25 per dollar to 155. A move so violent, so sudden, that every trader in the world knew exactly what it meant. Japan had just fired the opening shot in the most expensive currency war of the 21st century. But here's what makes this story truly alarming. That April intervention was just the beginning. What followed was a desperate, multi-month battle that would see Japan burn through more money defending its currency than most countries have in their entire foreign reserves. And the real question isn't how much they've spent. It's whether any of it will actually work. Before we dive deeper into this unfolding crisis, I need you to do something. Hit that subscribe button right now and turn on the bell icon so you don't miss the next chapter of this story. Also, drop a comment below telling me where you're watching from and what time it is in your location. I want to see how global this audience really is. Now, let's get back to the money. The Japanese Ministry of Finance waited until May 31st to confirm what every trader already knew. Between April 26th and May 29th, 2024, Japan had spent 9.8 trillion yen defending their currency. That's $60.2 billion, burned through in just over a month. To put that in perspective, that's more than Japan spent in all of 2020 to trying to stabilize the yen. And here's the kicker. It barely worked. The yen strengthened temporarily after each intervention, sure, but within days, sometimes hours, it was sliding right back down. The market had figured out the game. They knew Japan's Ministry of Finance was desperate. They knew the Bank of Japan's hands were tied. And most importantly, they knew that no amount of intervention could change the fundamental problem. The United States Federal Reserve was keeping interest rates high to fight inflation, while Japan's central bank was trapped at near zero rates. That gap, that yawning chasm between American and Japanese interest rates, was like gravity, and gravity always wins. But Japan didn't stop. They couldn't stop. On July 11th, the yen was weakening again. Japan's response, another intervention. This time estimated at around $22 billion. Then on July 31st, they did something they hadn't done in years. The Bank of Japan actually raised interest rates, moving from nearly 0 to 0.25%. It was the highest rate Japan had seen since 2008. They were sending a message to the market. We're not playing around anymore, except the market sent a message right back. And that message came in the form of one of the most violent global market crashes of 2024. August 5, 2024, the Nikkei 225, Japan's flagship stock index, collapsed by 12.4% in a single day, the biggest one-day drop since Black Monday in 1987. But this wasn't just a Japanese problem. The ripples spread instantly across the globe. The S&P 500 fell 3%, European markets cratered. The -1, Wall Street's fear gauge, spiked to levels not seen since the COVID-19 panic of 2020. What the hell happened? 2 words that strike fear into the heart of every risk manager on Wall Street. Carry trade and wind. Let me explain this in plain English, because understanding the yen carry trade is essential to understanding why Japan's currency crisis isn't just a Japanese problem. It's a ticking time bomb sitting under the entire global financial system. For decades, Japan has had the cheapest money in the world, near zero interest rates, sometimes even negative rates. So here's what the smart money did. They borrowed yen, massive amounts of it, essentially for free. Then they converted those yen into dollars and invested in American stocks, bonds, real estate, anything that paid more than zero. The profit wasn't just from the interest rate difference. As the yen kept weakening year after year, those investors were making money on both ends, earning 5 to 6% on dollar investments while the yen they owed kept getting cheaper to pay back. How big was this trade? Conservative estimates put it at around $250 billion. But here's where it gets scary. That's just the loans we can track when you factor in derivatives, foreign exchange swaps, synthetic positions, and offshore vehicles like those special purpose entities in the Cayman Islands. The real number could be over $500 billion, $500 billion of borrowed yen, spread across global markets like gasoline waiting for a spark. That spark came on July 31st, when the Bank of Japan raised rates. Suddenly, borrowing yen wasn't free anymore. And suddenly, those leveraged bets started losing money fast. Between July 11th and August 5th, the yen appreciated by over 6%. From 160 to the dollar down to 145. That might not sound like much. But in the world of leveraged currency trades, a 6% move is catastrophic. Every hedge fund, every algorithmic trader, every momentum investor who was short the yen got margin calls. When you're leveraged 10 to 1 or 20 to 1, a 6% adverse move doesn't just wipe out your profits, it wipes out your entire position and forces you to sell everything else you own to cover your losses, which is exactly what happened. Japanese investors and hedge funds started dumping their most profitable, most liquid holdings. US tech stocks, Nvidia, Apple, Microsoft, the momentum darlings that had been carrying the market all year. They weren't selling because they suddenly thought it was a bad investment. They were selling because they needed dollars, needed them immediately, needed them to buy back yen and close out positions that were bleeding money by the minute. The Mexican peso crashed, the Australian dollar plummeted, the Brazilian real, the South African rand, all the high-yielding emerging market currencies that had benefited from the carry trade, they all collapsed in unison. This wasn't about fundamentals anymore. This was about survival. Here's where the story gets really dark, because this isn't the first time the world has played this game with Japan's currency, and the last time it happened. It destroyed Japan's economy for 30 years. September 22, 1985, the Plaza Hotel, New York City. Finance ministers from the G5 nations, the United States, Japan, Germany, France, and the United Kingdom, gathered for what would become one of the most consequential economic meetings in history. The Americans had a problem. The dollar was too strong. American manufacturers were getting crushed by foreign competition, particularly from Japan. The trade deficit had exploded to $112 billion. Congress was screaming for action. Protectionism was in the air, so the Reagan administration came up with a plan. They'd force a coordinated intervention to weaken the dollar. The target was a 10 to 12% depreciation, orderly, controlled, manageable. Japan, under immense pressure from Washington, agreed. Finance Minister Takashito even said publicly that Japan could accept the yen appreciating to 200 yen per dollar. They thought they were being reasonable. They thought they were avoiding a trade war. What they got instead was a currency catastrophe. The yen didn't stop at 200. It didn't even pause. From 240 yen per dollar before the Plaza Accord, the yen rocketed to 153 by July 1986. A 41% appreciation in less than a year. By 1988, it had hit 120. Japanese exporters, the backbone of the entire economy, were being priced out of global markets. Toyota, Honda, Sony, companies that had built empires on export-driven growth, saw their profit margins evaporate overnight. The Japanese government panicked. They slashed interest rates. Trying to cushion the blow, they launched massive fiscal stimulus programs. They encouraged banks to lend, anything to keep the economy moving. And it worked, sort of. What they accidentally created was the biggest asset bubble in modern history. With cheap money flooding the system, investors went crazy. Real estate prices in Tokyo became so disconnected from reality that the grounds of the imperial palace were supposedly worth more than all the land in California. The Nikkei stock market index went parabolic, hitting 38,915 at the end of 1989. The world's most expensive indoor beach was built. Projects that made no economic sense got funded because, well, who cared about economics when money was free and everything was going up? And then it all came crashing down. 1990, the bubble burst. Stock prices collapsed. Real estate values imploded. Banks that had lent trillions against inflated property values suddenly found themselves sitting on mountains of bad debt. The Nikkei wouldn't return to its 1989 peak for 33 years, not a typo. 33 years, an entire generation lost. This is what Japanese policymakers remember when they talk about the Plaza Accord. This is the nightmare scenario they're desperately trying to avoid. And here's what makes the current situation so terrifying. The parallels are everywhere. Japan holds $1.1 trillion in US Treasury securities. That's not a typo either. $1.1 trillion of American government debt, more than any other country on Earth. It represents roughly a quarter of Japan's entire GDP. And in May 2025, Finance Minister Katsunobu Kato said something that sent a chill through financial markets worldwide. During a television interview, he was asked about Japan's treasury holdings. Could they be used as leverage in trade negotiations with the United States? His answer: "We obviously need to put all cards on the table in negotiations. It could be among such cards." Now, Kato quickly walked that back. He clarified, he explained, he reassured. But the damage was done. Because everyone understood what he was really saying. If America keeps pressuring Japan on currency and trade, if Washington keeps demanding that Tokyo strengthen the yen or open its markets or accept unfavorable terms, Japan has a weapon, the nuclear option. They could start selling treasuries. Not all at once, not a fire sale, but enough to make things very uncomfortable in Washington. Here's why this matters. The US government is already running trillion-dollar deficits. Interest payments on the national debt now exceed defense spending. Treasury yields are at levels that make it expensive to borrow. Very expensive. If Japan, the largest foreign holder of US debt, started dumping treasuries, even gradually, it would spike interest rates across the entire yield curve. Mortgage rates would soar. Corporate borrowing costs would explode. Credit cards, car loans, student debt. Everything priced off treasuries would get more expensive. The stock market, which is priced based on the risk-free rate that treasuries provide, would face immense pressure. This is why they call it the nuclear option, because using it would hurt Japan almost as much as it would hurt America. Selling treasuries would cause the yen to spike even higher, absolutely crushing what's left of Japan's export competitiveness. It would trigger losses on Japan's own remaining treasury holdings. Japanese pension funds and insurance companies, which hold massive amounts of US assets, would see their portfolios implode. It's mutual assured destruction. Financial addition. But here's the thing about nuclear weapons. You don't have to use them for them to be effective. Just having them changes the game. When Prime Minister Ryutaro Hashimoto made an offhand remark in 1997 about maybe selling some treasuries, the resulting panic forced an immediate retraction and an apology. That was for a casual comment. Imagine if they actually did it. This is the leverage Japan now has, and it's leverage they've never really had before. Because for decades, the relationship was simple. Japan needed American security guarantees. Japan needed access to American markets. Japan needed to keep Washington happy. So Japan bought treasuries, kept quiet, and played nice. But times have changed. China holds over $760 billion in treasuries and has been selling them aggressively for years. Russia dumped their entire holdings. The world is slowly, quietly, starting to move away from dollar dominance. And Japan, watching all this unfold, is realizing they have options. Not good options. not options they want to use, but options nonetheless. Let's talk about Kazuo Ueda. He's the governor of the Bank of Japan, and right now, he has the worst job in global finance, because every decision he makes is wrong. If he keeps interest rates low, the yen keeps falling, imported inflation keeps rising. Japanese citizens see their purchasing power erode as everything from food to energy gets more expensive. The cost of living crisis deepens, political pressure builds, and the currency speculators keep betting against Japan, knowing the central bank won't defend the yen with higher rates. But if he raises interest rates, he triggers the carry trade and wind, global markets crash. Japanese stocks crater because exporters get hammered by a stronger yen. And worst of all, he risks triggering deflation all over again, because raising rates in an economy that's barely growing, in a country with a debt-to-GDP ratio over 260%, is playing with fire. Higher rates mean higher debt service costs for the government, which means more pressure on the budget, which means potential austerity or tax increases, which means less growth, which means deflation, the very thing Japan has spent 30 years trying to escape. This is the trap the Bank of Japan finds itself in. Damned if they do, damned if they don't. And the Ministry of Finance, burning through billions in intervention, knows that currency intervention without monetary policy support is just throwing money away. It is like trying to bail out a sinking ship with a bucket while someone is still drilling holes in the hull. But here's what's really keeping Japanese policymakers up at night: the historical precedent. Because every time in modern history that Japan has been forced to choose between a strong yen and economic growth, they've chosen the yen, and every time, it's ended in disaster. The Plaza Accord wasn't just a one-time event. The lesson Japanese leaders learned was this: when Washington wants something, you give it to them. Because the alternative, a full-scale trade war with your largest trading partner and military protector, is unthinkable. Except now, that calculation is changing. Now, with China rising, with American political dysfunction increasing, with the global economic order shifting, Japan is starting to wonder, maybe the unthinkable needs to be thought about. Here's what most people don't understand about the yen crisis. It's not isolated. Japan's interventions, the carry trade and wind, the potential treasury sell-off, these aren't just Japanese problems. They're systemic risks that could trigger the next global financial crisis. Let's start with the most obvious connection: Japanese banks. Major institutions like Norinchukin Bank and Japan Post Bank hold hundreds of billions in US Treasuries and mortgage-backed securities. When the dollar strengthens and the yen weakens, those holdings look great on paper, but when the yen surges, which is exactly what happens during intervention or carry trade and winding, those banks face enormous unrealized losses. Norinchukin already sold $63 billion in treasuries in 2024, taking massive losses to avoid even worse problems down the road. Japan Post Bank has over $550 billion in U.S. bonds sitting on its balance sheet, representing huge potential losses if they're forced to liquidate. Now extend that to Japanese pension funds. The Government Pension Investment Fund alone manages over $1.5 trillion, with about $400 billion in U.S. assets. These aren't speculators. These are the retirement savings of an entire nation, if they have to bring money home to deal with yen strength or domestic political pressure. That's $400 billion that could flood out of U.S. markets. Not because they want to, but because they have no choice. Then there's the corporate sector. Japanese companies from manufacturers to trading houses have massive dollar-denominated revenues and yen-denominated costs. Every time the yen strengthens by 10%, it wipes out billions in earnings. Companies that budgeted for 140 yen per dollar suddenly facing 130 or 120, they have to cut costs, which means layoffs, which means reduced domestic spending, which means weaker economic growth. But it gets worse, because Japan isn't the only country in this boat. South Korea, Taiwan, Thailand, countries across Asia that competed with Japan for export markets are now watching nervously. If Japan manages to engineer a weaker yen through intervention or policy shifts, it puts their exporters at a disadvantage, which could trigger competitive devaluations across the region. which is how regional currency crises start. Remember 1997? The Asian financial crisis began with Thailand's baht. But it spread like wildfire across the region. Currencies collapsed. Stock markets crashed. The IMF had to step in with massive bailout packages, and that was in an era where global financial systems were far less interconnected than they are today. Then there's the European angle. The euro has its own problems, with the European Central Bank struggling to manage inflation and growth across 20 different economies. If global risk appetite collapses because of a Japanese crisis, European markets won't be spared, and if the dollar strengthens massively as Japan and other countries sell U.S. assets, it puts enormous pressure on European exporters and European bonds. Every major crisis of the past 30 years, from the Asian financial crisis to the 2008 global financial meltdown to the European debt crisis, they all had the same characteristic: interconnectedness that nobody fully understood until it was too late. The yen carry trade, Japanese treasury holdings, global currency markets. They're all wired together in ways that even the experts don't fully comprehend, which means when something breaks, and something always breaks, the damage spreads faster and goes further than anyone predicts. So who wins in this crisis? And who gets destroyed? Let's start with the obvious winners. Currency speculators who bet against the yen in early 2024, then flipped their positions during the interventions. They've made fortunes, timing those violent swings, knowing when Tokyo would step in and when they'd step back. That's been one of the most profitable trades of the year. Hedge funds that unwound their carry trades early, before the August crash, they locked in years of gains and avoided the bloodbath. The smart money, as always, knew when to exit. Then there's U.S. exporters. Every time the yen weakens, American goods become more competitive globally. Boeing, Caterpillar, agricultural producers, they all benefit from a weak yen because it makes Japanese competitors more expensive. But for every winner, there are far more losers. Japanese consumers are getting crushed. Food prices up, energy costs soaring, everything imported, which in resource-poor Japan is almost everything, has become significantly more expensive. Real wages, adjusted for inflation, are falling. The average Japanese household has lost substantial purchasing power over the past 3 years, and it's not coming back. Japanese exporters, supposedly the beneficiaries of a weak yen, are in a bind too. Yes, a weak yen makes their products cheaper overseas, but their input costs, the raw materials and components they import, have skyrocketed. Toyota's profit margins got hammered in 2024 despite the weak yen because energy and materials cost so much more. The currency benefit was completely offset by higher costs. Japanese taxpayers are also on the hook. Every yen spent on currency intervention is money that could have gone to infrastructure, education, healthcare, or debt reduction. That's $62 billion in April and May. That's real money. That's wealth transferred from Japanese citizens to currency speculators who bet against the yen and forced Japan to intervene at increasingly worse exchange rates. Then there are global investors in Japanese assets. The Nikkei crashed 12% in a day. Anyone holding Japanese stocks or bonds through that got annihilated. Mutual funds, pension plans, retail investors who thought they were diversified by investing in Asia, they all took huge losses. But here's the real loser: the entire post-war economic order that made Japan wealthy in the first place. That system, where stable currencies, open trade, and U.S. security guarantees allowed countries like Japan to focus on export-led growth, is breaking down. And Japan is discovering, along with the rest of the world, that in a system without rules, where every country manipulates their currency and trade policy for advantage, everyone ends up worse off. The race to the bottom has no winners, only different speeds of losing. So where does this end? How does Japan's desperate currency war resolve? Here are the scenarios, from most likely to most catastrophic. Scenario 1, a muddle through. Japan continues periodic interventions, spending tens of billions every few months to smooth out the worst volatility. The Bank of Japan raises rates very slowly, quarter point by quarter point, trying to support the yen without crashing the economy. The yen stabilizes somewhere in the 140 to 150 range against the dollar. Not great, but manageable. Global markets adjust. The carry trade stays mostly unwound, reducing systemic risk. And everyone just accepts that this is the new normal, a perpetually weak yen. Periodic interventions and elevated inflation in Japan. It's not ideal, but it's stable. This is probably the 60% scenario. Scenario 2. The Fed pivot. The US Federal Reserve, seeing weakness in the American economy or rising unemployment, cuts interest rates sharply. That narrows the interest rate gap between the US and Japan. The dollar weakens. The yen strengthens. Japan's currency problems largely resolve themselves without further intervention. This is a 25% scenario. It requires the Fed to prioritize growth over inflation control, which they've been reluctant to do. But if the US economy softens significantly, it could happen. Scenario 3. The Plaza Accord redux. Facing escalating tensions, the major economies, US, Japan, China, the EU, sit down and negotiate a new currency accord. Some kind of managed system where countries agree to bands or targets for their exchange rates. Would require unprecedented cooperation at a time when geopolitical tensions are extremely high. This is maybe a 10% scenario. Possible, but unlikely given the current state of international relations. Scenario 4. The crash. Something breaks. Maybe Japan really does start selling treasuries. Not as a threat but because they need the liquidity. Maybe another wave of carry trade unwinding hits. Maybe a major Japanese bank fails because of losses on foreign holdings. Maybe Chinese economic troubles spread across Asia. Whatever the trigger, the result is a cascade. Currency markets seize up, stock markets crash globally, credit spreads blow out. The financial system faces the kind of stress it hasn't seen since 2008. Central banks have to step in with massive interventions and maybe even coordinated bailouts. This is only a 5% scenario, but it's the one that would change everything. The reality is probably somewhere between scenarios 1 and 2. Japan will muddle through with periodic interventions and very slow rate hikes. The Fed will eventually cut rates, reducing some pressure. The yen will stabilize at a weaker but sustainable level, and global markets will adapt. But the underlying fragility remains. The interconnections, the leverage, the trillions in cross-border positions that could unwind, they're all still there, waiting for the next shock. Because here's the brutal truth about modern financial crises. They don't happen when everyone sees them coming. They happen when something unexpected, something seemingly minor, triggers a cascade that nobody anticipated. The yen carry trade unwind in August 2024 was a warning shot. A reminder that calm markets can become violent markets in hours. That leverage amplifies not just gains but losses. That currency intervention, no matter how much money you throw at it, can't change fundamental economics. Japan has spent over $100 billion in 2020 for trying to defend its currency. That's more than most countries' annual GDP. And the yen is still hovering near 30-year lows. The interventions bought time. They smoothed volatility. They prevented even worse outcomes. But they didn't solve the problem. Because the problem isn't fixable with currency intervention. The problem is structural. Japan has an aging population, massive government debt, zero interest rates after 30 years of trying to escape deflation, and an export-dependent economy in a world that's moving toward protectionism. Those aren't problems you solve by selling dollars and buying yen. Those are problems that take decades of reform, structural change, and painful adjustments. This story isn't really about Japan. It's about what happens when the global financial system, built on cheap money and stable currencies and open trade, starts to break down. For 40 years after World War II, the system worked. The Bretton Woods Agreement, then the Plaza Accord, then the Washington Consensus. There were rules, explicit or implicit. But there were rules. Countries didn't manipulate currencies too much. Central banks coordinated when needed. Trade was mostly free. Financial flows were mostly stable. And when problems arose, the United States, as the guarantor of the system, stepped in to smooth things over. But that system is dying. Maybe it's already dead, and we just haven't admitted it yet. The US doesn't want to be the global police anymore. China wants to write its own rules. Europe is fragmented and inward-looking. Emerging markets are tired of playing by rules that always seem to benefit the developed world, and Japan, loyal, reliable, rule-following Japan, is discovering that following the rules doesn't protect you when the rules stop working. So, they're spending billions to defend their currency, threatening to sell treasuries, watching their citizens suffer from inflation, and trying to figure out how to maintain their standard of living in a world where the old playbook doesn't apply anymore. This is the new reality: currency wars, trade tensions, nationalism over globalism, every country for itself. And in that world, the question isn't whether Japan's interventions will work. The question is whether any of us are prepared for what comes next when countries stop cooperating and start competing for survival. Because that's the real story here. Japan's desperate currency war is just the opening act. The main event is still to come. The question is whether you'll be ready when it arrives. If you found this story valuable, hit that subscribe button and turn on notifications. The global financial system is shifting in ways that will affect your wealth, your investments, your future. Understanding what's really happening beyond the headlines and the spin, that's not optional anymore. It's essential. Now drop a comment. Tell me what you think happens next. Does Japan keep spending? Does the Fed pivot? Does something break? I want to hear your predictions. Because in a world this unstable, the collective wisdom of thousands of viewers might be the best forecast we have. Thanks for watching. I'll see you in the next one.